the worst thing that anyone can tell me is no, because I'll push against it and prove them wrong. Let's work this back and go, where do you want to go? What are you looking for? And what strategy are you trying to go on? What's the biggest reason why clients are being declined for a mortgage? And the number one reason out there when they're going is
Chris Adlam, one of the UK's most creative and proactive independent finance brokers. He's worked for two of the biggest high street banks. He's made more millionaires than he cares to mention. This is the secrets of a property investor. I'm James Poynton. So if you're ready, I've got some explaining to do. Chris, take us from the beginning. You trained as a PT, is that right?
That's correct, yeah. So seems a long time ago now. So I left school in 2003, so people can kind of age me from there, really. And kind of, what do you want to do? I wasn't sure what I wanted to do, and I found a YT program, youth trainee program, and I went to work at a gym. I did a Princess Trust 12-week development course first, actually, and then a part of it I had to get 2 weeks work experience, so I found that in a gym. I've got another bash at doing that. I did that, and then they offered me a job at the end, actually, which was quite nice. It was a very fulfilling role. The whole idea was going to go there, learn the ropes from pool plant, so running the chemicals down, looking after the swimming pool, running the gym, looking after the gym, doing qualifications to become a personal trainer, down to admin and general stuff that came along with it, not to mention all the cleaning and stuff that goes on behind the scenes of the gym. And I kind of naturally gravitated, as you would expect, into the finance side of things. So it got to a point where I became the administrator for what was coming up a 2,000 member club, generating the thick end of £40,000-50,000 a month in recurring direct debits, and just generating a lot of money in that industry. And it was pleasurable, really. I kind of understood the back office, the process, the procedures, managing staff, and it made you grow up really quickly, because if you look back, I was probably 17, 18 at the time doing that. And I'm 17, 18-year-old trying to manage members of staff that were potentially 3-4 times my age, because they've not been used to doing it. And then after a stint in the fitness
So what happened
industry,
then? What changed?
I don't think there was a change, to be honest. I think it was me that changed. I just kind of saw the glass ceiling where you sit there and you kind of go, a friend of mine's the manager there, and he's managed big clubs, and it was more the glass ceiling. If you're going to be a manager in a club, you're only going to earn a certain figure. And then, so it was looking and going, well, I want to do more with my life. I do want to earn more money. I want to have those financial freedoms. I want to, because I come from a background, go right back. I come from a background where I lived in the same house with 3 generations on benefits. No one's ever owned their own home. No one's ever really worked. And I made sure that that wasn't going to be the role that I took on. So I wanted to have that little bit more with my family, with my own personal family. And I wanted to move on. I met my now ex-wife at work and was inspired to kind of, you know what, if I want more, I've got to go and get more. And that was when back and just went on to read.co.uk, and on the right-hand side, people that it was down in Darlington, people recruited in your area. It said HSBC. I applied and got the job, and I left the fitness industry in January 2017. For those that can spot the date, so January 2017, just before the financial crash. So I got a very steep learning curve, what was going on. Like back then, I remember when base rate was at 5.5%. Back then, and here we are at the dizzy heights of 0.75, and just seeing it crashing, and people not seeing it in their lifetime, people new to banking and just understanding it. And working with businesses at HSBC then, and kind of understanding what they're going through, and people handing keys back to their houses because they're going bankrupt. It was like, as much as it was growing as a person, it was a sad time that you saw this. And then I worked my way up within HSBC, and for those that remember Abbey National, they just launched something called Abbey Business Banking. It was when Abbey first started doing business banking and asked me to go across.
Yeah, I remember that.
So it was innovative at the time because they just said, we're going to be the only bank that does fee-free business banking. The co-op do one for FSB, but we're going to do it for everybody. So I went across. I was about the 16th person in the country working out of Darlington, but I had multiple branches. I was looking after Darlington, Stockton, Middlesbrough, Hartlepool, Newton Aycliffe at one point. So I had that entire area looking after business banking clients. And then, again, worked my way up, went for a promotion, and the cheek to tell me I didn't have enough lending experience. So it's like, right, I'll show you who's not got any lending experience. And we had a look around, got sick of saying no, and sick of not having the products available for our client base. And so I went there, and the guy that said I didn't have enough lending experience, I look back, he did me the greatest favour that anyone's ever done, to be honest with you, to tell me no. Because it's the worst thing that anyone can tell me is no, because I'll push against it and prove them wrong. It's like, well, it's not no, it's just that you've not seen how to do it, or there's got to be a way of doing this. And I think this is where the creativity comes in for finance. But this guy told me no, and I moved on. But just as a side note, that guy there was one of the founding directors of what is Atom Bank and then GBB Bank. So this guy knows his stuff. And I don't know if it's because he saw something more in me, saw me pushing against it, genuinely didn't think I had enough lending experience. But this guy has written a few books now. It's a guy called Craig Eiley. It's worth looking him up. He told me no, but he's probably done me the greatest help than anyone else in my entire career by telling me no. And it's amazing.
Things always happen for a reason, don't they?
They really do, mate. They really do. And it's amazing when people are on your journey and something comes out of the way, whether you call them wines in the road or just ripples in the street, whatever you decide to call it to justify it in your head. But these people come into your life for some reason. They come out of your life for a reason. And whether they've had a positive impact, a negative impact, but even the negative people that have had impacts have positive impacts because you might change something, you might adapt something, and it works really well. But he said no. So at the time, my boss, a guy called Steve Hoskin, was being made redundant from Santander for the second time. This guy must have retired about 4 times now, and he was setting something else up. So I said, you know what? He ran it past me, because he knew how well I was doing at the bank. No intention of me going across. He just wanted, because he knew how commercially minded it. He just wanted my thoughts on it. So, you know what, Steve? I wouldn't mind being part of this. So me and Steve kind of came together. We joined forces. We launched a business together, and we started trading out of an office at Wynyard, just over at Teesside there. And then after a few years, that was in 2013, me and Santander parted ways. But then so started 18th December 2013 was my last day at Santander. So 19th of December 2014, I was on the road officially, fully self-employed. Wrote my first deal just after Christmas as an independent broker. And I remember it to this day because coming from a bank where somebody was telling me, if you've got want to lend a client more than £25,000, it's got to be secured. I lent a client in Darlington £100,000. It was unsecured. It was my first deal I'd ever written. And even 2 weeks after the deal paid out, I'm sitting there going, that money okay? Is it still in your bank? No issues? Because I was positive someone's going to go, we've lent you £100,000 unsecured. We've done this wrong. So just kept checking up on him just to make sure it was okay. But lo and behold, it was, wow, this is great.
How would you describe your business now?
Our business, I think the best way, it is a full funding solution. And as much as that's quite a cliche thing to say, anytime a client's got a need for a pound coin moving in a transaction, we have a solution to have them. And the reason why I have that solution is because I want to understand and be able to facilitate it, whether it be a client wants to remortgage their own home. They want to buy their first home. We can do it. They want to finance a car, a van, or a vehicle. We can do it. They want to finance any form of asset. We can do it. They want to buy the first buy-to-let. We can do it. They want to go to auction. We can do it. They want to do multi-million pound development finance deals. We can do it. If ever there's a reason for a pound coin moving in a transaction, we can facilitate it. And the reason why we've decided is because so often, I've said this many times before, sometimes people perceive that they're getting bad advice from financial services, and it's not. We get people at what we call tied agents. They can only give you advice based on the tools they've got in their toolbox. I'm in a very fortunate position that my toolbox is probably the largest, if not the largest, in the UK, and with more direct lending. We are locally based. We have the most comprehensive set of lenders and lending parameters in the UK than anybody, really. So if ever there is a transaction to be done, we can facilitate it in some way, shape, or form. And the biggest thing and the biggest learn for me on that is we were, a few years ago, we were recommending our clients, or when they needed to do a regulated mortgage, we couldn't do it. And we got to a point where it was, I'm just sick of seeing clients walk out the door or transactions being held up because I couldn't control them. And for anybody that's worked with us, they know I'm a control freak, whether I get in touch with the solicitor end and I'm bashing the solicitor over the head to get a deal paid out, or I'm bashing an accountant, or I'm bashing the bank. I like to control the transaction. And if there was a weakness or something I didn't have access to, I'd make sure I did.
Yeah, so you say you're bashing solicitors over the head. So do you get involved with solicitors as well to help your clients?
So a lot of the times clients don't understand what they're being asked for. I think this is fair to say. My job should start with a finance request and end when it's been offered. That would be the letter of the law, but that's not what clients need. Clients often don't know what they're being asked for. So if I can speed it up by speaking to the solicitors and go, look, you've asked for this, it seems a bit over the top. Can we work away? One of the big things that you might hear during legals is, I need searches. Well, can we get something called no search indemnity? Now, that's quite a big thing during COVID, actually, without mentioning the dreaded C word. And the reason for that is local authority searches were taken at one point up to 6 weeks. I can normally get no search indemnity put in place in 3 hours. So why would we want to delay a transaction by 6 weeks because we're waiting for searches to come back? But you as a client wouldn't know this is available to you. The lender's not going to offer it to him because, well, why do we want to insure it when we get no search? If no one's going to push back and make sure we get it, then we're going to go down this route. So because I can see what's being requested, I can go, yeah, this is a bit over the top, let's do this. Or they've asked for something and I can spot what's wrong, normally a million miles out, and go, actually, we don't need this for X, Y, or Z. Let me sort this problem and go back to the lender and we'll get that requirement dropped. And we can do these sorts of things because as far as I'm concerned, it's my job to take a deal from cradle to grave. My clients do not pay broker, they pay advice fees. And I'm part of that service and a critical part of it. And if I have to hold my client's hand to get a deal put to bed, I will, because what I've said to a few, and I say to a few people, this might be, as a property, this might be the third, fourth, fifth time you've bought a house, fifth time you've used a solicitor. Chances are it's not even the fifth time I've done it that day. So because I've got the benefit of having so much experience, I don't mind weighing in and talking, because although I'm not a solicitor, I can talk solicitor speak. And during lockdown, I was very fortunate that my wife works for a legal practice. So downstairs in the front office, I had a brokerage. In the back office, I had a solicitor's practice. I went, can I just run this past you because it seems a bit daft? What would you guys do? And it was really nice, actually, to be able to have that on hand.
What an advantage. That's amazing. Because I must admit, I don't talk the same language as solicitors. I just do. I've read letters from solicitors and I just do not understand their language. Why can't they just speak the same language as us? You know, so how difficult is it? But there you go.
Exactly. Remember, these guys get paid per 7 minutes on the billable. So what we want to do is go, right, why send the paragraph to see when a 4-page letter will do? Whereas I always tell people the most maneuverable person in a transaction really is your broker, because your broker is the only person that can talk to you as the vendor, can talk to the vendor's solicitor, it can talk to the bank, and it can talk to the bank solicitor. The bank, when you're represented, the bank can't talk to you because they've got to talk to your solicitor. And how many times have we all had it where you hear, I've sent an email and went to come back. Why have you sent an email? Pick the phone up, ask the question, rather than us waiting for something. We all get, how many emails do you get a day? I know I get hundreds. So sometimes if you send me an email, it gets answered at the back end of the day when I've finished reviewing my emails. So if that's the situation for me, solicitors will do the same. So whereas if I can pick the phone up, speak to them and go, this has come up, can we sort of say, yeah, I don't see that being a problem. Bang. We're a lot further down the line. We're waiting for 2 days for an email to be responded to. And when you're talking about faster transactions, when we've got to do it, so bridging being a big one, if you've bought a property at auction and we need to complete in 28 days, we haven't got time to wait for 2 days for an email to be responded to. We need to be on it, and we need to be dealing with it really fast. And we need to create that sense of urgency. And unfortunately, if two people within a transaction aren't talking, we've got to be able to do it.
That brings me nicely on to bridging, because this show is all about trying to help people. So the people that are listening right now, we need to try and help them if we can and understand different parts of the industry. And that's why I have all these different guests on. So tell us about the different products that are available. Let's start with bridging.
Anyone that knows me knows that I love bridging. Now, bridging is also the best product I have for my arsenal, and it's the worst product. The reason why it's the best, I do not have a product that's more flexible that gives me the agility where I can get it paid out anywhere near as quick, other than maybe car finance. But when I'm talking about property, that is the quick. The worst product, and I don't mean in terms of for customer experience, because it's a great product when you've got the right people in the right places. What I mean by worst product is times a worst rate, because the perceived risk on a bridging loan, or when we've got to use a bridge, tends to be higher. So you pay more for the perceived risk. So if we were doing a residential buy-to-let mortgage, as an example, we might be paying 3% right now, interest. Whereas we do this on a bridge, 75% loan to value on a purchase, we might be paying 0.75, 0.7, 0.85, wouldn't be a million miles off. There are cheaper, but this is at the higher loan to values of 75%. So bridging finance, as far as it can be very expensive. But when you understand how we use it, why we use it, when we use it, then it demystifies the entire area. There tends to be 3 or 4 reasons why we would use it. The property, we need to move at a rate of knots, so speed. You've bought property at auction, you've got 28 days to complete, otherwise you lose out and you lose your deposit. Now, with the best will in the world, putting a standard mortgage in place, I have done it, we have achieved it, but I'm sure it aged me about 15 years during the process, because if we didn't complete, the client was going to lose his £15,000 deposit, which we don't want. So we always say, look, we can do it, but bridging on something like this, because the whole idea is getting it done quick. The other reason why you might use bridging is the property is uninhabitable. So you need to go in, do a bit of tart and turn on it, really. You need to go in, you need to put a new kitchen in, put a new bathroom in, get rid of some damp. Could be anything, but there tends to be a reason why you need to go in. So that's another reason. Or you wanting to go in, renovate the property, take advantage of the new valuation, pull your money back out. You try to do that on a standard mortgage, a lender would have a dicky fit. They don't like it. That's why we have short-term lending products. And the other reason is because we're doing something creative, whether that be you've managed to negotiate a property drastically below market value. So it's got, let's use some random, it's got market value of 115k, you're buying it for 80k, you want to take advantage of that benefit of you negotiating that lower purchase price. Now, you can't do that on a traditional mortgage because the traditional mortgages say that it's based on the lower of the purchase price or the valuation. Whereas we can do it on a bridge. We've got plenty of bridges now that will say we will lend based on the market value. If the market value says it's worth 115k, we will lend you 75% of that minus fees. So on that basis, as investors, your deposits are going that bit further. And we can remortgage that out, put it back onto a buy-to-let, release that equity, get you off the bridge. And I did one on Friday. Guy bought the property for 140k. It's valued at 140k. So he's bought it for 100k. It's completed on Friday. We're already turning it out onto term debt mortgage now. We're going to put it with a lender, and they're going to lend us at 75%. Loan to value based on, because he thinks it's actually worth 150k now. He's done a little bit of a remodel to it, done it up a bit. So we're going to do 75% loan to value. He's going to pull all of his money back out, cover the stamp, cover his costs. He's got no early repayment charges on his bridge. He's going to be in and out. Yeah, it's cost him a bit to do it, but he's effectively bought a property with no deposit. So we've been able to do this, and he's recycled his money really fast.
Cool. A quick question about the 75% on a bridging. So you can loan 75% on the bridge with a bridge. Can you do 85%, 95, and 100?
No, there needs to be some skin in the game. So we can do 100% of market value, but not of loan to value. Now, there is ways where we can do additional security in the background where we can cover your deposit, but what you need to look at, if things go bad, how's the bank going to get their money back? And not only that is, you almost need to see it as a bit of security for yourself. So if we've got 100% and something happens drastic in your life, you can't afford to pay the mortgage, you're at 100% loan to value, which was, if we go back far, and Northern Rock were doing these back in the early 2000s, 100% loan to value or even above that. We repossess a property, we sell that property, and then you're underwater. They're coming back to you for the money. At least at 75%, even 80% loan to value, you're at a position where if things do go bad, you sell the property, you've got a bit of equity, enough to pay off the mortgage, enough to pay some fees, and you've got some money back, really, rather than you being stuck on a deal or you're in negative equity and they start coming after your personal assets to make forced repayment on this sort of stuff.
And what about basic, buy-to-let mortgages?
Buy-to-let mortgages. So we do more of this than anything else at the moment because we did so much bridging back end of last year. I'm actively managing the takeouts of these bridgings that we did. So buy-to-let mortgages, limited company or in your own name, whatever it may be. Typically, our clients are around 75% loan to value. We can go up to 80% loan to value. Limited company loans, there's some cracking rates out there at the moment because this marketplace is expanding. Now, whether it be what we call buy-to-let mortgages, I'm just going to put a few products on the same wrapper because these are for HMOs, homes of multiple occupancy, MUFBs, multi-unit freehold blocks, service accommodation, holiday lets, standard single lets. They're all under the same. It's a mortgage product. It's an investment-led product where someone's paying you a rent, you're paying a mortgage. Simple as that. You get an investment return from it. Depending on the product line, we're going down to, we tend to be around 75% loan to value. It tends to be a fair. There's a couple of nuances in there that allows me to go up to 80% loan to value, but you've got to look at it from a bank's point of view. Perceived risk, the higher the loan to value, the higher the rate. They want a return on their money. They've got a perceived risk there. So the lower the loan to value, lower perceived risk, the better the rate you're going to receive. So there's some cracking deals out there, and there has been. And it's a very competitive marketplace now. There are some other lenders coming into the marketplace where they are going great guns to soak it up because they can see how important property investors are and the journey is that they want to support, and it is a marketplace they want to be part of. If you go back long enough before the Section 21 tax and things that was going where you're not able to offset your interest costs, Well, everyone typically just had them in their personal names. Now, as limited companies, the reason why people is because they can offset that little bit more. I'm not qualified to talk about tax, but the general reason why people are doing this is to lower the tax rate, to get the better coverage on it, and to get them out of their personal to save themselves on their personal income allowances. I've got plenty of accountants that are advising clients to do this and going, Chris, do me a favour, sort this portfolio out. It's in the client's personal name, and we're moving it across into their business name just for speed and ease.
So what other products could we cover? Could we, for everyone's listening, so there's commercial products as too, can we talk about those?
Yeah, absolutely. So from a commercial point of view, you have the benefit of, so let's start with semi-commercial mortgages, because I'm doing a talk about this in a commercial and semi-commercial in a couple of weeks' time. But to start with these, one of the big things people say to me is, Chris, I've heard I need experience to do this. And like anything with lenders, you could be right, you could be very wrong, because everything depends on the situation. There are lenders that will say, I need experience to borrow against a semi-commercial property. There's also lenders that will go, no, we're 70% loan to value, we're quite happy. But it's all within context. But in the main, semi-commercial mortgages, we can get up to 75% loan to value. For an investment-led transaction, the rate would normally start with about a 5. So if we said 5.5, 5%, something like that, we wouldn't be a million miles out. And you typically, when we say semi-commercial, if you think of your good old-fashioned, we've got a shop downstairs, we've got a flat upstairs. That could be, but it could be any number of securities, really. But it could be as long as under the single title, and you've got a commercial premises and a residential premises attached to it, whether it be side by side, back to back, one up, one down, or 2 downstairs and 4 upstairs. It doesn't really matter. That's a semi-commercial product. And that tends to be, as I say, maximum of 75% loan to value. And clients are going more and more into this industry, actually, that because of the rental returns that we're seeing. But more often than not, I'm getting the same question is, I've been told, Chris, I need experience. Well, yeah, there are lenders that will, but the benefit of being a broker is I don't have a credit policy. I've got lots of lenders' credit policies, so I can sit and go, well, you won't fit ABC banks because you're right. They want you to be managing a semi-commercial property with at least 12 months experience. But then I've got other lenders that go, well, can't do 75%, but they'll do 70% for you. And as long as there's sufficient rental income in there, we don't need to take out any of your background rental income into consideration. They'll happily do it for a few years, get you the experience, and we'll remortgage it to a lender with a better rate because, again, perceived risks. If you've got more experience, the chances are you're going to get a better rate.
Very good. So could you help us with the pitfalls to avoid?
Pitfalls on semi-commercial? Yeah, so one of the biggest pitfalls that we're coming across, and something I'm going to be covering on this talk, is a lot of people speak to me and it's like, what I plan on doing, Chris, is splitting the title. Splitting the title on a semi-commercial property. Now, it's a great idea, and when it works well, it works unbelievably well. And some situations where it can work well are, so let's say you found a property, it's got 4 flats upstairs, 2 commercial properties downstairs. Now, typically, that, like I said before, that would go on a semi-commercial mortgage, let's say 75% loan to value or 70% loan to value. Rate normally start with a 5, 5.5 over base, something like that. So the rates aren't fantastic. Whereas if you said to me, right, Chris, they're on separate titles. I've got 2 commercial properties downstairs and I've got 4 residential upstairs. By splitting the title terminology that people use or onto a lease, as long as we don't fall below minimum security values, which that's your pitfall, it works well because it means that on the commercial element, the client will pay the higher rate, but on the pure residential element, they'll get to benefit of rates of just over 3%. So on that basis, by us doing the exercise with our clients and working out the difference, we can say, actually, there's potentially a way of us saving you 2% on this just by getting a little bit more clever with it. But that's when it goes well. When it goes bad, it can bite you in the backside and this is where having a good team around you. Now, I am not a valuer. I don't profess to be a valuer. I've never professed to be a valuer. But one of the things I have to tell people is around minimum security value. So if on situations like that where we've split the title, so if upstairs all hunky-dory, that's valued fine. But for some reason, the commercial element is below 100K now, as an example, you could have effectively devalued because I've got very, very few lenders that will do a commercial investment loan on a security less than 200K valuation. And that's where the difficulty comes in, you see. And that could be quite a large pitfall if you haven't taken advice or you haven't spoken to an estate agent or even a valuer or anybody, and you've just gone off. Like anything, it's all about doing your due diligence and making sure you've elected to do sufficient due diligence, because otherwise we could be in a position where you've inadvertently devalued your entire transaction.
Just a quick one. If you're enjoying this, hit the follow button and share it with friends. Back to the show.
So what I want to help people listening with as well is, could you take us through the process from when they start talking to you, and also what should they have prepared prior to speaking to you?
I am a little bit different where so what do I need? And it's like, look, let's just have a conversation first, because don't get too hung up about speaking to me first, because it's all about the conversation, understanding what your journey is going to look like. Understand your journey, and then we'll take you through it. But in the main, if we said, right, we've got a brand new client, what do we need? We need to understand who they are, where they live. We want to understand the journey they're going on. So what's your intended strategy? Are you going down the buy, refurbish, refinance? Are you going down, no, I'm just going to buy single lets? Are you going down service accommodation? Are you going down HMO, multi-lets? Are you going down the commercial or semi-commercial? By understanding the route you're going down, I can guide you with the information that's needed. But if you're brand shiny new, we kind of want to understand, okay, where's your deposit coming from? Who's your bill to? Have you got any experience doing, even if you've got no property yourself, but let's say you're a builder by trade or something, then you've got some experience that we can put through where you might not have done any yourself, but you've done hundreds for other people. So it's understanding your own personal journey. We'd need proof of income, as you would expect. We would want some bank statements to follow that up so we can basically do some anti-money laundering checks. But once you take out the compliance piece, as we call it, the main thing is let's understand your reason why in the journey you're going on. Because once I understand your reason why in the journey you're going on, we can talk, because I've got so many products in my arsenal that you can sit there and I could almost scare people into non-movement because I don't know what to do. It's like, well, let's work this back and go, where do you want to go? What you're looking for? And what strategy you're trying to go on. Because when I know the strategy you're looking to go down, I can talk to you about the products, whether them be refurbishment products, whether it be straight up buy-to-let products, whether it be HMO mortgages and what we tend to see that we're going to need, how the valuations work, how the bank's processes work, how the lender's going to work, if we need a QS, a quantity surveyor, if we are able to do these transactions just on a desktop valuation, or we have to do a full survey, client with there's valuer actually coming out to site viewing the property. So we just need to understand the journey that you plan on taking, so we can advise you on the path that you're going to be doing. So we're just a bit like a finance GPS, really. You tell us where you're going to want to get to, and we'll plot the route that you're going to go down.
How did you, I mean, there are obviously certain qualifications, including the FCA, that you have to go through to do what you do. Talk us through what else you've done.
So as I sit here today, I'm currently, the ones that are pertinent to this industry is a chartered banker, which I got that when I was in the banking industry, which is kind of understanding where that's come from. So it doesn't really allow you to do anything other than the fact that you do want to get a bit more of an understanding of banking and the framework that sits behind it. I'm CMAP qualified, which is the Certificate in Mortgage Advice and Practice, and I'm currently CERA qualified, which is Certificate in Regulated Equity Release. I'm currently studying to do my diploma in mortgage advice and practice, but I don't really need it, but I want it. It's one of these where you kind of go, well, what advantages or disadvantages? Advantages for me, it keeps me more upskilled than the next person on the street, being honest with you. And the whole idea of that is to be able to give my clients the best advice on the road to and keeping the business on it and making sure that when we're doing our CPD, continual professional development, when we're able to take our clients, we're actually able to do it and remain best in class. And that's all I ever want to ensure is that my clients are getting the best advice and the best service. And we have the best products available and to get them through onto the best situation. So that's the route I take them down. And because I'm taking them down that route, I want to make sure that I'm sufficient and my colleagues, we're sufficiently in a position where we're qualified to be able to have these conversations. Because one of the things I say to people all the time, I'm CERA qualified, which is Certificate in Regulated Equity Release. And I use that qualification more often than not to tell people not to do take out CERA, because what that's for is that's for lending to people into retirement. So over 55s lending, so they might like lifetime mortgages and that sort of stuff. Now, I use that qualification to steer people away from doing them. But because I'm qualified to tell people not to do it, which is quite nice.
So just coming on to another subject, and this is one I think that a lot of people might stumble across at some point in their life, because sometimes shit happens. So what about bad credit? Because sometimes we have beliefs that, oh, I've got bad credit and I can't do this and I can't do that and I can't get that. How does it work with mortgages? Because there are certain rumors that it doesn't matter because the money's against the property that you're buying and blah, blah, blah. And my mate in the pub says, and can you squash all those for us and give us clarity in it?
Yes, man in the pub advice, mate. It is the worst bit of advice we ever get, and I can't stand it. So, because for the most part, the man in the pub advice is right for their situation, not yours. So, one of the big things I always tell people, we're not in America, so ignore the score. It's all about activity. You might log on to Experian, it might tell you you've got 999 credit score on there, but it's all about the recent activity on there. Just because you've got a score of 999 does not mean you can get a mortgage. Just because you're with Equifax and you've got a score of 200 does not mean you can get a mortgage. So the first bit of advice I always tell people is do not go running around in ever decreasing circles. Go to the one place that sources all the information. Use Check My File. It is the best, most comprehensive credit search and credit file system out there. It is the only multi-agency report. It gives me the information from Equifax, Call Credit, Experian, which is now called TransUnion. So you've got Experian, Equifax, and TransUnion that used to be called Credit. So that's all it gives me. So it's 3 data agencies, and I get to see everything. I can go back, I can see when you've missed the payment, when you've put yourself in an arrangement to pay, when you've been late. And these are the things that a lender's going to be looking for. I can see if you had an IVA, I can see if you've been bankruptcy, I can see when you got a CCJ, who slapped it on you. And when I say who gave it to you, I mean by the court. I can't see that Parking Eye has given it to me because I refused to pay their parking fine. I could just see when the court put it on you, how much it's for when you're satisfied. I can see everything if you're on a credit file. I can't get this by going to Experian. I'd have to go to all of the 3 reports and merge them into one file and do exactly this. So that's the best one. But if you have had credit blips, have I got lenders? Yes. If you're in an IVA, have I got lenders? Yes. If you've just been discharged from bankruptcy, have we got lenders available? Yes. The beauty of being a brokerage, we do not have a lenders parameters. We have lenders that have credit guidelines, and we fit you with the most appropriate lender. People always say to me, what's the biggest reason why I get declined why clients are being declined for a mortgage that I see. And the number one reason out there when they're going is because the property's been downvalued. It is not because you've got credit score. Because 9 times, like us as a broker, we've approached the right lender immediately because I ask for everyone's credit score when I'm doing an application with them because that way I can see everything and then I've got nothing hidden. The fact that you might have taken a payday loan in the last 3 months causes me issues with some lenders. So on that basis, I want to see what is there so I can have a look. And the number one reason why we get the clients is going to be down to that because we've put you to the appropriate lender first. Whereas the number one reason why I get when clients come to me and say, Chris, I tried to do this with an ABC brokerage, they're struggling. Can you have a look at it for me? And go, yeah, not a problem. Well, they shouldn't really have approached that lender because it was never going to fit their credit policy. So I'm sorry that you've just wasted X amount of weeks getting this done. But again, as much as you can't really badmouth, and I don't badmouth other brokers, that just might be the tool that they've got in their arsenal at the time. So they've gone to a lender and they've tried their arm a bit to see if they can get it through because it used to be able to get through, or sometimes they can have a conversation, but it's been declined and it's not worked. But top and bottom it shouldn't have gone there. It was a more appropriate lender, but you're not going to know unless you're dealing with somebody a whole of market that you've gone to inappropriate lender because you're not giving the advice, somebody else is giving the advice.
Why do you think people are declined and how can they avoid it?
Non-disclosure is a big reason, to be honest with you, James. It's huge in the industry. So what this is for, and it's never been more open, honest and transparent you can be with a broker. Because the reason for it is it's up to us to judge where you sit with a lender. Because if we don't disclose something, and it's the reason why we ask for credit files, etc., from whether it be, don't know, you've taken a bounce back claim but on your limited company, we've not mentioned it, or you're trying to back someone's man down the pub advice strikes again has told you actually you just put a buy-to-let mortgage on a holiday let, anything like that. Non-disclosure tends to be the biggest reason for a decline because as a broker, it's my job to know a lender's credit criteria inside and out and put you with the most appropriate lender. However, if you decide to non-disclose or not be open, frank and honest with us, and the lender finds out during the underwriting process, it will unnerve them because actually why weren't we told about this is a fundamental change to the credit application. Did the broker know about this, which means I could potentially get in trouble because they think that I'm trying to do non-disclosure. Or if none of them have happened, it's like, well, why is the client doing that? Well, it equates to potential mortgage fraud. So it's a big word, but that's what it could potentially be. So the number one reason is non-disclosure. And I'm not saying people do it from malice. So 9 times out of 10, I don't see it. And the reason why I see it, especially with the bank of clients that I have and the source of the business comes from, it's more naivety than anything else. Because I don't think anyone ever does anything to try and pull the wool over my eyes or to do it over the lender. But anything that's a material change, if you're going to change what the security is actually, it's a buy-to-let, but I'm letting it to my daughter. Well, that's not a simple buy-to-let. We need to know if it's being let to family, or are you letting it to more than 3 individuals? Well, as a standard house. Well, if that's the case, more than 3 individuals, that's most lenders' criteria for HMO. Is it going to be a short-term let? Oh, no, I'm going to put somebody in it. And sometimes these things happen accidentally, and I have seen it. So I had clients where they've had a buy-to-let on the coast, so let's choose somewhere. Let's say they've got somewhere over in Blackpool, as an example, and it was a simple buy-to-let, but it just wasn't letting or wasn't working in that area as a buy-to-let. And they thought, as business people do, right, how can I do it? If I turn it into service accommodation, I'll get more rent from it and I'll rent it out. And I've not done it out of malice. I didn't go into it to do that, but it's kind of happened that way so they can get the property let out working.
Yeah, that's a great suggestion, isn't it? And then, if it's not working, then let's turn it into service accommodation. But, I mean, personally, I never knew that you'd have to tell the mortgage company.
Yeah.
So what do you have to do? Do you have to change the mortgage or do you just have to let them know?
Yeah, so let's use some lenders as an example. So let's say we're doing we've done a simple buy-to-let with TMW, the Mortgage Works, as most people know, part of the Nationwide group. So you go to them, you've done a simple buy-to-let, they've approved it, it's gone through. But then, actually, it's not really working as a simple buy-to-let. I'm going to have to turn it into service accommodation, a holiday let. Now, they don't do that, so you would have to break them all, go to them, tell them that you're doing it, break the mortgage and take it elsewhere. It has to be for the reason it's in. And sometimes this is the reason why rate isn't always best, because if I sat there and had a conversation with so James, tell me what you're planning on doing. Well, what I actually plan on doing, I'm going to do this. If it doesn't work, I'm just going to bump it over to something else. Well, if that's the case, the sensible thing for us to do would be use a lender that does both holiday let mortgages and does buy-to-let mortgages, because then at least they won't, 9 times out of 10, they won't bump you out of the lent and say, right, you've got to repay this loan. They'll just go, right, we're just going to have to increase the interest rate to make the difference between a buy-to-let mortgage and a holiday let mortgage. And 9 times out of 10, they're fine with it. But if they don't have that product available, they're going to demand formal repayment of the loan immediately, and you've got to take that into consideration.
Yeah, so the best advice then for anyone listening is when you're having a conversation with your broker or even Chris, is full disclosure. What do you want to do? Where's your end goal? Where do you want to be in 5 to 10 years' time with it? And, where we're going. And if it doesn't work, do you want to change it to an SA or what? Do you want to change it to an HMO?
Exactly, man. Exactly that. And it's like, what's your backup plan? What's your background? I've been doing this. What's your 5-year plan? Because if you sit there and go, it's a simple buy-to-let, what's your 5-year goal? My 5-year goal is I plan on having, I've been learning about service accommodation. Like, as a broker, something going back to me and it's like, so are you planning on using this as a buy-to-let? Well, no, not really. Or, yeah, I am. And we can navigate our way through it. As I say, like, I've got clients who have gone buy-to-let, changed it out, but we just go, right, we just need to change permissions on it. Speak to a lender. 9 times out of 10, the ones that do both, they're quite happy. It's when it's blatant and it's underhanded that they really don't like it. So thankfully, it wasn't one of my clients, but I went in here to fix it. Got a client who was buy-to-let. As far as he was concerned, he was letting it out to a family member. Doesn't really matter, but what most people is that becomes a regulated activity. Most lenders don't like regulated buy-to-lets. Especially in this space, especially when you're looking at limited companies. And because of that, his mortgage broker just put it through. Now, it wasn't anything underhanded on the terms of my client. It was on his mortgage broker because he was fully aware. And we ended up fixing the situation. We did have to take it elsewhere, but that lender charged the client because they found out that he was letting it to his daughter. Still charged him £2,500 early break fees. Then we had to take the remortgaged it elsewhere, and got it all sorted out, and it's there for his daughter. And this is the sort of things that can happen with non-disclosure.
Yeah.
But
it's the unknown, isn't it?
It really is. You don't know what you don't know. And as big, bright, and clever as what people are, if you're trying to do something, a lender's probably seen it 50 times. They know what they're looking for. They're experienced. They do training on this sort of stuff on a daily, weekly, monthly basis and what to look out for on an application. So on that basis, it's like, look, just rather than something happening and having to, because can you imagine being told, right, you've got to make formal repayment within 28 days on something? Right, your backside's going to fall out, and if you can't get it through, and then in addition to it, what people don't realise is one of the questions that I get asked as a broker: has a client ever had a mortgage declined, removed, or had formal repayment requested of them? And it's not got a moratorium on it, so it's not within the last 5 years, 7 years. It's, has this ever happened to a client? And as a broker, I've got to disclose. Yeah.
You have, yeah.
So-and-so banks demanded a formal and immediate repayment. And because of that, I have to explain the situation behind it. And what people don't realise is you might be dealing with ABC Bank, but they have a in-house system where all the lenders share information about it. So they can go on and type in your limited company, ABC Buy-to-Let Assets Limited, and it will pop up for what lenders have put basic information on there. So it's not even worth hiding.
They're asking for honesty, aren't they? Like, they already know.
Yeah, of course they do. They just want to be open, frank, and honest. And The ones that will get, because that's all that anyone's asking in any financial transaction, because the worst thing that will happen is they find out you can't do anything. You end up getting convicted. And one of two things will happen. You get convicted for mortgage fraud, which is the end anyway, or you get a CIFAS marker put on you for mortgage fraud. You get a CIFAS marker put on you, you won't be able to get anything from home insurance up to a mortgage ever again.
Wow, what is CIFAS?
So CIFAS is, you might see it on your credit file every now and then. It's to see if there's any warnings. And basically it's a government agency that, and people tend to have them on it for one or two reasons. Whether they've got the same name or they've had fraud committed to them, or they've been suspected of committing fraud in the past. And that's the big thing. They've been suspected, so you don't even have to be committed of committing fraud. And someone can bang a CIFAS marker on you, and every lender's going to look at you differently. Going, why am I getting to a financial transaction with this person? They're clearly not open, trustworthy, and honest because so-and-so bank. And then you have to go through the whole situation of getting them removed, or it being, the good thing about GDPR is everyone's got a right to their own data, and people have got the right for the information held about them to be open, and it has to be transparent, and it needs, most importantly, needs to be up to date. So if it's wrong about it and it's not up to date, they have got a legal obligation, thankfully, to do this. But that's not going to matter if you've just paid 10% on a buy-to-let at auction to put a deposit down on a property, and all of a sudden you've got to get that marker taken off you. Well, they're not going to care that you can't get funding because you've got the CIFAS marker against you.
Right.
It's not their problem.
So is it possible to get the CIFAS markers taken off?
It is. The last one I saw, it took the client 18 months to get it taken off because he had to.
Wow. Okay.
And his situation was he had his debit card stolen and the PIN number from his bank, and they was withdrawing cash. He went to the bank and they refunded him the money. And whilst it was going on, because let's be honest, how often is it that you can get your debit card and your PIN stolen from you? So they thought it was actually the applicant committing his frauds, and it was going to ATMs that didn't really have CC, so they couldn't prove it. Turned out to be a member of his family. Unfortunately, was committing his fraud on him. So it wasn't just to him. So he ended up paying back the bank and saying, look, I don't want this person to get into trouble. So they paid it back themselves. Did it, gave the bank the money back, but by that point, damage was already done because the bank suspected this person of committing a fraud when, as I say, it turned out to be a family member who was nicked his card originally and then nicked his card and his new PIN number.
Right, I see.
So
I see a lot of people, me, myself included, joint venturing with people. So how does this work for a joint venture? How, you've got, say, 2 people, 3 people, it could be 5, whatever, and they set up a limited company. How do they get their first property bought, and what kind of mortgage they want? Say, for instance, they want to buy to let something.
Well, I think first and foremost, I think we need to almost go back a stage with that question, Jim. It's like, whenever you're doing a JV, joint venture with somebody, let's just be careful who you get into bed with. And the reason why I say this is, imagine you're doing this, you get halfway down the line and one of you turns out to have adverse credit. So if you're getting into business with people, be frank, open and honest, because it might be that actually how you're trying to structure. This goes back to about being frank at the beginning with us, because if we see actually this person's got CCJ, there's another way we could structure this limited company, this purchase, so it doesn't actually affect you. But well, first and foremost, I think before you're getting into business, find out who you're doing these JV with. Find out what their credit situation is, because if they don't, I'll find out, and everything comes out as part of the credit process.
Yeah.
Now, whenever you're getting into it, just find out what everyone's bringing to the party, whether they're bringing skills, experience, or cash. And then not all shareholdings have to be equal. The amount of times I've seen it where we've just formed a limited company and shareholder 1 is putting most of the cash in, so he's getting 50%. Shareholder 2 and 3 are putting in the expertise, so they're just getting 25% each. There's lots of different ways that we do it, and it's all fundable. And one of my big throwaway sayings is every deal is fundable. All comes down what you're willing to pay. Now, on something like that, do we do it? Do it all the time. We do complicated structures where we see shareholders limited companies within limited companies. That's quite common these days. So let's say me and you set up a JV between us, we go out and want to take on the world of property, but I don't want the shares held in my name, you don't want it in your name, so one of my limited companies, ABC Holdings Limited, owns the shares. On yours, DEF Holdings Limited owns your half of the shares. Now, that's quite common these days, but you'd be surprised how many lenders that actually participate in that. I think it's the greatest structure in the world. Accountants love it, but it reduces so many lenders. Great example that I got a phone call from an accountant last week. He's been working with a mortgage broker friend of mine, actually, to do this. So look, one of my clients has been working with this person. What they're trying to do is this complicated structure, and we can't get it through because they're saying they don't have a lender. The shares have to be owned in their name, not in another limited company, so it can't be done. And this goes back to what I said before. It's like, technically they're right with one or two lenders, so we find a lender that accepts that structure. Now, he was offered at the time to have it in the shareholder. I think the rate was like 2.95. I managed to get it away with an alternative lender. It accepted that limited company setup where it's limited companies within limited companies, and the rate was 2.98%. So he's paying 0.03% difference for a lender that accepts that conflict, because this other broker was like, no, you've got to do it. There's no one will do it. No one will do it. It's got to be in your own name. Well, there is. There's generally a reason, as long as the situation, like people, what we call with alphabet shares, where you'll have a limited company and they'll have A class shares, B class shares, C class shares, D class shares, and they all have voting right. And as long as to the broker, to the lender, to the underwriter, the reason for this shareholding's complicated structure makes sense, then they'll do it. But if it's, well, why have you just overcomplicated this transaction? They will ask those questions, because sometimes people might have just gone and said, oh, I've watched a 2-minute TikTok on it and I've set it up myself, and because I know my way around company's house and I don't understand the rationale behind it. And if that's the reason for it, it's like, well, you can't overcomplicate the transaction here for no reason. But when you go on to when we talk about JVs, don't forget there's also other ways where if you're trying to acquire a portfolio, you can actually do a JV with the current vendors, where you take over most of the shareholdings. They take a reduced amount of the shareholdings. You get to buy their portfolio with putting very little money down.
That's a good link into no money down deals. So please help us out with that one, because I've heard of it. I've not actually seen anyone do it. I mean, like, you take us through an example.
Right. As we spoke about before, mate, as far as I'm concerned, there's no such thing as a no money down deal. There's a low money down deal. And what I mean by this is we're always going to be some form of cash. So whether it be you've got to pay a valuation fee, you've got to pay a broker fee, you've got to pay your stamp duty, so SDLT, or if you're in Scotland, land and building tax, or you've got to pay some solicitor. There's always going to be somebody who wants a bite in a transaction that's unfundable and we can't wrap into the deal. Because the best one I know, the market at the moment is such thriving. For people to do true no money down deals, they're having to get some absolute bargains on property. I'm not saying they're not out there. Even this week, I've myself been offered a bargain of a property, and it's a great deal. The situation makes sense, but you've got to kiss a lot of frogs to get to these bargains, and they are doable. So I got a phone call earlier on from a client. He's found a deal. It's the purchase price is $320 to $350. The valuation's $450, so we can get as near as damn. So normally, if somebody was saying to me, right, Chris, I've got this deal, it's worth $450. I want to put it onto a mortgage, but it's $350. I'd be saying, right, well, it's low of the valuation on the purchase price. So on a $350 purchase price, minus 25%, I'm asking you for £87,000 in deposit, plus fees, legals. We're getting upwards of 100k deposit I need on it. But because we can get really clever by using bridging at market value, we're actually doing it at 450k minus 25, well, it's 28% it works out because you've got brokers and lenders fees that gross it up slightly. So he's buying it for 320. We can lend him a maximum loan of 324. He will service the interest for a month or two, but then we'll kick it out onto a buy-to-let mortgage. And then he's effectively, I worked out that on that particular deal there, he was only going to be putting down 30k there or thereabouts. And where that comes from is a bit of budgeting for legals, a bit of budgeting for valuation, and I think stamp duty we worked out to be about £22,000 on that transaction. So for him, it's like he's just bought 450k's worth of property for the thick end of 30k rather than putting in 100k. So it's not a no money down, it's a low money down. And now if you've only got 100k in your budget, we're soon recycling this money. Instead of buying one asset, we're buying 2 or 3 of the same asset. Yeah. So we worked out when he's finished doing that, that's going to cash flow him like 1,600 quid a month net just by putting the rents where they should be. So he'll be out of that deal within 15 months. It'll fully cash out, and then his money's infinitum after that that he's making. And then, so that they are possible, they are out there. Can it be done? 100%. But if you truly have no money, let's try focusing on other activities that generate you more money, whether it be deal sourcing, packaging, introduction, just something that's generate you some cash where you can do it. I talk to people about people who've only got a limited amount of wealth unless they're very lucky and they've got bags and bags of cash in the background. And unfortunately, flipping is a dirty word. But I always say to people, it's like, if your deposit's low, why? A lot of my clients have started going down this flip one to retain one strategy. So it slows them down at the beginning. They buy a property to specifically flip, make another, pull all their money out and might make another 20k. Now that 20k, they'll use that to roll into their retained property. So they'll flip a property to retain a property, flip a property to retain a property, so that they are constantly recycling their deposits, and whatever profit they make on that flip, that's what they use to retain their property. So otherwise, if they all of a sudden they just keep deploying the capital, they might be stood still for 5 years, 7 years, until the property prices go up and they can pull the cash back out. At least this way, they're always moving. They keep moving forward.
Yeah.
And that's a strategy that a lot of my newer clients are taking on board because of how the marketplace is right now. Because if they can't get these fabulous below market, if you can't get 25, 30% below market value, and you get 15% below market value, well, 15% below market value on a 100k property, I'm still going to make 15 grand by flipping it, by making it more desirable. But that 15k, I could roll into 175k buy to let, but I've got my deposit and I can do it. So again, that flip one to retain one is a great strategy for people with low budgets.
Good idea. Good idea. This is why people should probably speak to you. How do people reach out to you if they want to talk to you?
So by far the easiest way is drop me a text, to be honest with you, because like most people, I tend to be attached to them. So my mobile number is 07584 291 My email address is chris@advanced with a D funding.co.uk, or just add me on a good old Facebook. It tends to be where people get me. On there, when people connect with me, they'll see that we do various things, from just pumping out a bit of information, talking to people about debt service coverage ratios and how to equate what sort of income you're getting on your property, which I pump out on my personal Facebook page, to some of the talks we do, which are all for charity. So we once a month we'll do a talk, whether it be this month's on semi-commercial and commercial. We're doing that this month. I don't charge a fee to attend these Zooms. All I ask is, look, we normally support various charities. And this month we're supporting a member of the PIA, actually. He's got a charity for his daughters where he's trying to raise £100,000. So this month we've said, look, everyone that wants to come, free to attend from my side. I'll donate my time. If you can donate £15 a head to this charity for Gordon's daughter, she's got a complicated medical condition, and we raise money for that. And I do that once a month. The charity does change. This month, as I say, it's for Gordon. Last month it was for Save the Children UK. Month before that, it was for the multi-neurone disease. I've got a friend whose wife was diagnosed with that, sadly, when she was only 34 with 2 young children. So we did that, and then didn't do one in December, but in November we did one for the Royal British Legion. Raise a stonking amount of money for them as well. So
that's fantastic.
Where possible. It's just our way of adding. And from a point of view, because I've got a lot of information like this as this podcast shows that we can give out, and I'll spend my time helping people, but it's nice that I can talk to people en masse and I can deliver it rather than going ringing people up and go. And people have got different learning styles. Like, I'm a very visual and a audio learner, where some people want to see it in black and white and they want to read it and understand it. So for me, I'm just trying to help people in whatever style they want, because whenever we do it, we always send out, there's normally a copy of the presentation that goes out in a Word document or on a PowerPoint presentation, or there's a calculator. There's always something extra that comes out, whether it be a leaflet or something, just so you've got something hard copy where you could just have a look at it and assess it and go, you know what, this is just something a little bit extra that's just going to help me on my property journey. Because as we both know, like, you don't know what you don't know. And if I can just make one person's journey a bit easier and stop them falling foul of anything from being taken advantage of, naivety, fraud, whatever, I'll sit there and help them, because I'm kind of on a mission, really, to help tidy up what can be perceived, and it is perception, perceived to be a very murky industry. However, like anything, unfortunately, it's the people that create the bad bush that create the big names. But there are some amazing communities that investors are creating themselves. Yourself, you're in one, and you've got those accountability people out there, and it's formed with some of the most genuine and nicest people in the industry that will just sit there and hold your hand and give you an hour of their time when they can go, look, can I just bounce this off you? And I'm only one person, but the fact that you guys have created that community to do it amongst yourselves is just amazing.
Yeah, it's a fantastic community, I must admit. The Property Investment Academy, for those of you that don't know it, it's run by Stephen Green, and it's been fantastic so far. We're all very, very supportive and honest, and there's a lot of trust between us as well. So all good, all very, very good.
Brutally honest, I might say.
Yeah. Call each other out on a bullshit, don't we? So just going back to the charity for Gordon, because I'd like to use this show as a bit of a vehicle to help people wherever I can, and it's about giving back. And Gordon has a Instagram page, and for people who'd like to go and support them, he's got triplets. So he's got a boy and two girls, but sadly one of the girls has got cerebral palsy, and she needs an operation, and they're waiting for a confirmation whether she's eligible or not. So if people would like to go to the Instagram page, which is _Yorkshire_triplets, and the giving page is in the bio there when you find it. So go there and have a look, and it's for a great cause. So Chris, just coming on as we start wrapping things up, what would be your top tips?
Number one, to be honest with you, is when you're doing your due diligence, start from home. Do your due diligence on everyone, whether it be from your power team, your solicitor. I've had this conversation today with somebody from us, and if the most important people within any power team is going to be your accountant, it's going to be your solicitor, it's going to be your broker, and all three of them need to have decent communication skills. So they all must be able to communicate with one another effectively and talk to one another and work with one another. And the reason why I say that is because I'm not qualified to give tax advice. That's for your accountant. Your solicitor, I'm not able to register your property and get it all done, get it through legals. That's what. But if we can all talk in such a way, it'll make your life so much easier, and understanding the people, what roles these people make within your property journey. So, as an example, just because somebody's called an accountant doesn't mean they're an accountant. They could just be a glorified bookkeeper. And unfortunately, people don't realise there is a difference between the two. Now, I might be coming to you asking for an account certificate, and if you've got a bookkeeper, they cannot sign off this very important document, which will slow down your transaction. So have you got an accountant or have you got a bookkeeper? Now, if you've got a bookkeeper, absolutely fantastic. There is nothing wrong with them, but just bear in mind for your property journey, you may want an accountant to support you and look after you, or just sign off the audited work, whatever it looks like, just so it gets done. Solicitor, always elect for at least a 3-partner practice. There will be practices out there where it's just Joe Blogs. You've known them. They've been part of the family for years. They trade from the local office. You can just pop in. But the problem with that is lenders don't accept them. 3-partner practices is what we're looking for. And we are looking for solicitors, not licensed conveyancers. Now, I know plenty of excellent licensed conveyancers. I think they're absolutely fantastic. But a lot of lenders ask for a solicitor's undertaking. Now, if you're using a conveyancer, we cannot use them, which forms part of the process, causes a bit of an issue. Now, one of the other things, what most people don't realise, is when we're lending to a limited company, you will no doubt be asked what's called an ILA, independent legal advice. So let's say we're doing a traditional mortgage for you today, Jane. So, right, normal limited company mortgage. We will ask for a personal guarantee because there's no way we're going to let you hand the keys back to the lender. They're going to want to work with you. So as part of that personal guarantee, you're going to need ILA, independent legal advice, especially if it's your first one. If you're used to signing ILAs, then normally we can waive advice or save you having to pay that fee. But just bear that in mind, because sometimes that can hold up the process, because the solicitor's firm you might not use might not be big enough that they have a solicitor where they can do what's called Chinese walls, and somebody else within that firm who's not party to the transaction can give you the independent legal advice needed as part of that. Now, if you go into a 1 or 2 partner practice firm, this is not possible, and it causes us a little bit of an issue. So just that, my number one is going to be watch that policy. Make sure.
Yeah. Okay. Because surround yourself with the right people. Then, as you're saying,
it really is that, Jim. It's as simple as that. Because I can sit there and put any finance in place, but if all of a sudden it all gets unwound in legals because we need something from the solicitor or we need something from the accountant, and they're not able to do it, well, it's quite a big fall down at that point there. And as much as they might be your best friend, we just need to make sure that they're capable and credible and able to work on these transactions for you. The next piece of advice really is going to come down to the asset, what you buy, being what we spoke about quite a bit today, being open and honest. At the end, tell us everything. Even if you don't think it's pertinent, we'll decide whether it's pertinent or not. Don't try and hide anything because it will come out in the wash. So we need to know everything. And then when you're assessing your deals, one of the biggest things that I always tell people is something called DSCR, Debt Service Coverage Ratio, DSCR. Now, what this is how do you know as a client that a lender will take this deal on? And how you know is because you make sure that when we're lending to a limited company, you have a minimum of 125% coverage. Now, what does that look like in real terms? So let's say you're buying a property for 100K, you're putting a £75,000 mortgage on it. If we do a stressed interest rate on that, call it 5.5%, so 5.5% of 75K. Let's just do the maths on that and work out what your monthly payment would be. So
live maths, I love it.
Yeah, 75,000, 5.5%. That would be a monthly interest of £343.75, right? So 343.75. Now, if we times that figure in 3.3.75 by 125%, that gives us the minimum monthly rental income for this property to work as a rental would be £429.68. And that's all we do to assess it. There are a couple, that's a general rule of thumb. There are a couple of where we go, actually, we don't assess a stress rate, we assess a pay rate. So if the interest rate's only 3.2, we'll do it at 3.2. However, they are right, but this is different lenders. I'm giving you, in the main, if you base it on a stressed interest rate, currently at 5.5%, to make sure the rental income works, will this property stand on its own 2 feet? And on that basis, based on that, it absolutely does. And that's what, so you know that when you're underwriting and you're assessing your deals, that's the same process that a lender's going to take me through, same process a broker's going to do. Because with nothing worse, you found the property, and let's say you was only getting £400 a month rent from it. Well, the mortgage is only, I'm still not making a lot, making 60 quid, but it's 60 quid better in my pocket than someone else's. I was like, yeah, but in the main, it does not work for the lender. So at least this way you go, yeah, it works. Now, also remember, lenders look at your background portfolio. The reason why is in 2019, I want to say, maybe earlier, 2018, the PRA rules came in. So the Prudential Regulatory Authority, they came in to regulate lenders. And what that meant was whenever they're lending to a client, if they're regulated by a PRA, they have to assess your background property portfolio. So just because this property stacks up, but let's say the rest of your portfolio is at 82% loan to value, there's not enough rental income coming in for it to wash its face, then they would decline the deal because it doesn't stack up.
Wow, interesting. I never knew that. That's great advice. Thank you.
Yeah. So what do we do with our clients to combat it? Low value, high yielding products is one. An MUFB, multi-unit 3L block, going into your portfolio because they normally have high debt service ratios within them, or small HMOs, 4 or 5 bedroom HMOs. Nothing that's too time intensive, something that's going to give you a higher rental yield that will bring the rental yield up within your portfolio to make it all work. And we do this day and that where we just assess the portfolio to go, actually, does this work for most lenders? And so often we don't tend to have an issue with it in the north because we've still got low value, higher rental yields. We find a lot of these issues in the south, especially in London, because they're not getting the capital value of a property against the rental income is poles apart at the moment. And because of that, so we end up saying, it's like, look, you need to buy some more properties within your portfolio, and so we can make this stack. And the reason behind it is because your rental income across your portfolio is not sufficient. So we need to somehow bump up the ratios within you. And as I say, by bringing in them either lower value, higher income assets, or we're bringing in MUFBs, multi-unit 3L blocks, or HMOs, putting them in your portfolio would increase the yields on it, which makes your overall portfolio, puts it in a better position for lending.
Very good. Thank you for those tips. That's brilliant. So the previous guest that was on has left a question for you. So I'm just going to read it out. And actually, from now on, we're going to ask this question to everyone because I think it's a great question. What's the biggest life lesson you've learned?
My biggest life lesson is it's got to be, and it really is, an old adage, never judge a book by its cover, to be honest with you. I have seen some of the best property transactions coming from the most unsuspecting people, and people accessing some of the most amazing transactions just from, they might have been their gardener, for God's sakes, and they found a way because they've got built up that trust with them. And some of the stuff that we have seen go through is phenomenal. Now, there's a transaction for one of my clients that I'll always remember, and I talk about to so many people. And he's got a very good portfolio, love his portfolio, but he's had a couple of properties for some time now. And these properties just flat upstairs, flat downstairs. Low value properties, had them for 10 plus years, probably 15 plus years now, actually. And the rental income from them is just fantastic. Whereas you look at it and go, historically on something like that, it's just a 60, 70 grand terraced house, but he's getting 2 lots of rent from it. Whereas normally you'd probably only get $450 a month rent from it because of how we split the property and turned it into an MUFB, multi-unit 3L block, a flat downstairs and a flat upstairs. He's getting nearly £900 a month rent from it. And I talk about it to his portfolio, and I use that as an active example to a lot of clients because it's a great asset rather than going for these huge assets. Because when you're just starting out, a lender's got to back you with the best will in the world. And if you're just starting out and you're wanting to borrow millions upon millions of pounds, like, well, let's get a bit more realistic. Let's get some wool on your back first, and so that you actually understand this arena. And something like that, where it's low income, high yield, just fantastic assets to go after, and just work with your. And there are a lot of myths in the industry that I tell people about, and I spend my life just dispelling them, because there's a lot of
let's dispel some of those myths then.
Right, 6-month rule, load of rubbish. People always say, right, I've heard about this 6-month rule, Chris. I've got to own the property for 6 months before I can remortgage it. True, also rubbish. Going back to the beauty of being a broker, plenty of lenders that will do next day remortgages for me. You buy a property at auction today for 100k, it's worth 150k. Tomorrow, I can start the process of bang it onto a mortgage, get put onto a mortgage at the new market value. Next day remortgage. Plenty of lenders that will pick that up. You need experience to buy a commercial property. No, you don't. There's always a lender that will pick it up. They'll charge you a little bit more, but they'll do it. One of the other big ones is that we're coming across a lot at the moment is I'm able to liquidate. I've got no comeback on my bounce back loan if I liquidate it. Anyone that liquidates a limited company when there's a bounce back loan, or if anyone's lost any money, the first thing we're going to do, and most lenders are going to do, is look at recent liquidations. If you've liquidated anything, they're not going to like it. We're going to be in expensive lending for at least 6-7 years until that falls off any form of credit file, which people don't realise, and lower loan to values. And another one is, I don't own my own home. Can I start this? Well, let's start from the property journey. Just square off what I've just said there for a second. On your property journey, I've got bad credit. Can I start it? Yes. I don't own my own home. Can I start it? Yes. I'm recently self-employed. I haven't got 2 years' worth of accounts. Can I start my property journey? Yes. I've got low money. Can I start my property journey? Yes. There is so much. I can go on all day. Like, don't let your perception, let me tell you if a deal can't be done. Let a broker tell you if a deal can't be done. Don't you try and underwrite your own deal, because a decent broker, and they always say to them, it's my job to find out how to do it. And I said this earlier on, it's just like a financial sat-nav. You tell me where we're starting, you tell me where you want to go, and I'll build the road that gets us there, whether it be we're using all the tools in my arsenal, some of the tools in my arsenal, but we will get there. And every deal can be written. I might have to change a bit. I might need a little bit more of a deposit, might need less of a deposit. I mean, like small security. I might need to shape it a different way, but we can do it. We just need to think a little bit outside the box and go, you know what? We have got funders that will pick this up. Don't you think you're a dead duck because you're a dead duck? Because I've not come across a hopeless case yet. And sometimes it's kind of people have their preconceived conceptions about what the journey they're going to be on. It's like, well, let me decide whether you're fundable by talking to you. It's like, yeah, you might have had credit blips in the past. It means we're not going to HSBC, but it doesn't mean that we're going to go to the bank of God knows where charging you 25% APR. It's not how it works. Even with the worst credit, the worst on a buy-to-let purchase, even if you've gone bankrupt in the last you've just been discharged from bankruptcy in the last 12 months, the most I'm charging is 4.99. So it's still not ridiculous interest rates.
And would you say that's because they're securing the loan against the property, and that's why banks will lend against property, bricks and mortar, because it's, as they say, safe as houses?
It really is. And the other side of it is, they've been doing it for a long time, James, so they understand it. So when this goes wrong, if they're only into it for 25%, so on a normal valuation, you normally get 3 figures. Market value, 90-day val, which is what the property's worth for it to be sold in 90 days, and 180-day val. So what is? Generally speaking, the difference between the market value and 180-day is normally about 15%. So they know, worst case scenario, they can dump this in auction and get their money, most, if not all of their money back. And that's the reason why they only lend up to a certain percentage. So they sit and go, okay, worst case scenario, we'll repossess it, put some additional fees in, we'll put it into auction. We've taken adventures so we can act really quickly. We can enforce our security and we'll get our money back quick. And lenders will do that. So the reason why they'll do it is because as much as you're getting an income and they're helping you on their journey, they know they're getting an interest rate, but they've also got a clear exit if, for whatever reason, you don't come to the party.
I suppose it's all about that risk assessment, isn't it?
Of course it is. And that's why people check. Because if banks were charging, if it was all easy and vanilla and nice and easy, why would they charge an interest rate? Because they're guaranteed to get their money back. The reason why they charge interest is because there's a level of risk to it. Now, you could be at a tier 1 lender getting charged 2 and a bit %. We could be at a tier 3 lender and we're getting charged 7-8% per annum. But as long as you as the investor have calculated a deal and you're getting that return on investment that you're looking for, then almost the interest rate doesn't really matter because it's all about your return. If someone's willing to lend you a bit of money for you to earn it, you're not doing it to earn 3 or 4 quid. You're normally doing it to earn tens of thousands of pounds. So on that basis, what they're earning in comparison to what you're potentially earning could be huge. And that risk and return is massive.
Chris, it's been an absolute pleasure having you on and listening to what your advice and everything else is superb. So I should express my gratitude and thank you again. Yeah, we'll do this again soon. Maybe bring you back for other ones. Let's see.
No, I was saying I really appreciate the invite. It's great to be on here, and I've not done one of these before, so it's nice to kind of have that conversation. Thanks a lot. Appreciate it.